Hello, friends. Welcome to our weekly podcast. Today, with us, we have Miss Manvi Prabhu, who is the head of fixed income desk at Anand Rathi, and she is going to help us understand how we should invest in our debt instruments. Hi, Manvi. Welcome to the podcast. It is a belief that debt returns are always positive. Is that true?
Hi Karthik, thank you for having me. Well, debt, just like equity, is subject to market fluctuations and hence that may not stand true. Let's try to break this down a little. When we say debt, there are an array of investment vehicles available, like corporate FDs, bonds, debt mutual funds, etc. Now, to simplify why and how returns in debt could be negative, let's take an example. When we invest money in a corporate FD, say at 6% for 3 years, we fixed a return of 6% for 3 years. There is no downside or upside. So this investment is not subject to market fluctuations. Now, let's fast forward 1 year ahead. And if you want to make a fresh FD, now interest rates have risen and the interest rate on the same FD is 7%. Now your existing FD, which you made last year, is losing out on 1% for the remaining 2 years. So while you're not making negative returns, you are still having a notional loss of 1% for the remaining 2 years. Hence, though we believe there is no negative return, in practicality, you're losing out on an opportunity. This is called interest rate risk.
That was a different perspective. This, however, was notional. Do we see real losses in debt, and does this also apply to debt mutual funds?
So corporate FD as a product is non-volatile. When I say non-volatile, I mean it does not have a daily price that fluctuates, not as a trade. The return is fixed. Hence, such products do not see negative returns. However, mutual funds and bonds could see negative returns. Let's understand how that happens. We invest in a debt mutual fund today that has an average maturity of 3 years and assume a YTM of 5%. If I have to interpret this, it simply means the fund is invested in securities that mature in 3 years and accrue returns at 5% if you hold it to maturity. Now we know that mutual funds report a daily price which is commonly referred to as net asset value or NAV. This NAV is the price at which we can invest or redeem our investment in the mutual fund. Since we have invested in debt mutual funds, the NAV should theoretically inch up by the interest earned, that is the YTM per day. However, that is not the case. It could go down too. And we want to rewind back to the FD example where market interest rates have gone up. So instead of the original 5%, interest rates are now at 6%. And hence there is a fall in the price of the existing investment. But it will still continue to accrue at the original 5%. So to compensate or incentivize the new buyer for investing in a lower yielding fund, the NAV will inch up by the interest component, but it will also come down by the proportionate opportunity lost. And that is how debt mutual funds or bonds could show negative returns, where the market price is adjusting for the movement in interest rates. Let's take a converse scenario where interest rates have fallen. In such a case, the NAV would inch up by the interest component and it would also adjust for the increase in the debt instrument's price for the fall in interest rate or the opportunity gained. This is called mark-to-market impact. Market impact can also be an effect of credit loss. Now, when I say credit loss, a debt mutual fund has exposure to multiple issuers. And if any issuer from the fund defaults on interest or principal repayment, that will also reflect in the NAV, which again is mark to market impact.
So, you spoke about mark to market risk. How can we minimize this risk when we are investing in debt?
So, Karthik, this risk does not apply on non volatile instruments like FDs. But for volatile instruments like bonds and mutual funds, the key is to hold the instrument to maturity. It is always suggested to invest in an instrument that matches your investment horizon. So if you invest in a mutual fund or a 3 year bond that carries a 6% yield, and if you hold it for the 3 years, you receive your maturity proceeds without compromising on the 6% return. However, if you intend to exit the investment before the intended maturity, you will see mark to market impacts. The other way to minimize this impact is to understand interest rate cycles for which you can seek guidance from a professional. The extent of mark to market risk is a function of the duration of the investment. That is, the longer the duration, the greater the impact, both positive as well as negative. Our debt mutual fund model portfolio aims to maximize returns without compromising on risk. And in today's interest rate scenario, when rates have bottomed out, we have employed a combination of accrual and lower duration to reduce the overall mark to market impact. So I would always suggest that investors consult a professional before they make any investment decision to ensure that the investment matches their expected return for the risk being taken.
Thank you, Manvi. It was wonderful having you on the podcast. So, friends, that's it for this week. Don't forget to tune in next week for yet another podcast. Thank you.